The U.S. dollar staged an absolutely massive rally following the U.S. election and in the subsequent weeks. It's now, however, starting to look exhausted, and we're seeing signs of corrections emerging across a number of currency markets. After the U.S. election, the U.S. dollar took off. It rolled in like a hurricane, mowing down absolutely everything in its path, and particularly crushing some of the more defensive currencies like gold and the yen as capital flowed out of the defensive havens back into risk markets, like particularly the stock market. We've seen bonds also be getting crushed by this big US dollar rally. However, now we're getting to a point where the US dollar could be getting due for a correction. The dollar is priced in a much more aggressive Fed now. Recall that in 2015 and 2016 were years where we only saw one Fed rate hike. For 2017 right now, the US dollar is pricing in 4 or 5 rate hikes, at least one per quarter. And what that means is that if we get anything less than that, the US dollar could be vulnerable, just like it was in 2016 when the market was looking for 3 or 4 rate hikes. We only got one. In 2017, if we only get perhaps 2, for example, or even 3, the street could find itself being disappointed as the year unfolds. What could slow the Fed down? The big thing is actually that the US dollar is actually doing a lot of the Fed's tightening work for it because it's so much higher now. That actually acts as a drag on the U.S. economy. It makes it more difficult for U.S. exporters. It cuts into the overseas earnings of U.S. companies, and travel and tourism changes. It's cheaper for Americans to go abroad than for foreigners to visit the United States. So there's a number of ways that this could actually act as a slowing on the U.S. economy. And more importantly, the slowing is likely from the U.S. dollar is likely to kick in faster than the positive benefits of higher infrastructure spending, regulatory changes, taxation changes, or other policies brought in by the new Trump administration. So you get into what I call the hammock effect, where it sags in the middle, where you have this and high anticipation, but results may not come later, and you could get a dip in the middle while people wait for the results to actually come to fruition. So what are we starting to see here in the market? Well, we're seeing with the U.S. dollar, this goes back to about mid-November, but we can see after the big spike up from 95 to 100, it paused for a while, had another rally up in early December, and it's since paused. RSI momentum also pretty level, but we're starting to see in other currencies signs of a turnaround. So I'll show some of these now. We'll start with gold as an example here. Gold was truly crushed. Look at this, massively overbought here. It did hold 1120, leveled off, and it's starting to slowly creep back up. Likewise, the RSI is showing downward pressure is starting to ease, upward correction underway. Recently trading near 1140, 1150. The 23% retracement of the post-election sell-off would bring you back to 1172, and the 38% retracement would bring you back towards 1200. So it does look like there's room for a trading rebound in the gold price. The other one we're starting to see this show up in is in the yen. In this case, this means the US dollar was going up, the yen was going down. So the yen, again, was positively crushed in the last few months, and particularly after the election. It spike up, though, to about 118.60. Looks like that was the exhaustion rally. Since then, we've seen a number of inside days where the range of this 117 to 118.60 of this one day had become the range for the yen. Now look at this, it's starting to break down. It's broken 117, trading down near 116.70. This first support here was about 116.18, and this 23% retracement level here down around 114, the 115 round numbers in here. Looking at the RSI, new high up here, not confirmed by the RSI. Negative divergence said upward momentum was slowing. Now what are we starting to see? 70 has been broken. That's a signal as well that a correction's starting. And so this is showing that we could have more downside in the US dollar yen as it continues to roll over. Also looking now, we'll move to resource currencies, looking at US dollar CAD here. This also had weakened with the, so we've seen this rally here with the post-election where we saw it, US dollar strengthened, then the Canadian dollar strengthened along with the oil price. The US dollar fought back, but look here, in this 135 to 136 range, looks like we've got a double top forming here. Look at the RSI, once again, topping out below 70, telling us that this uptrend is likely running out of gas, and we could be starting to fall back. And so what are we seeing here? A test back to 135, 135.50, break of 135 would signal a downturn that could take it back towards this 50-day moving average here, closer to 134, and or this Fibonacci test near 133. That's been tested more recently, not even a week or so ago. The if we look now to the Aussie dollar, we'll see that here it might be in the process of forming a double bottom. So in this particular case, this is going up and down with the Aussie dollar. The Aussie dollar has been weakening. I'll bring this out to a daily chart. Just take a moment. And we'll see here that it was slammed pretty hard once following the election and the second time here in mid-December. But look at this. It's quite oversold. RSI turning back above 30. That's a signal of an upturn. And we're seeing this nice base building form here near between 71.50 and let's call it 72.25 here. This older support level here in and around 71.45 holding nicely here. This looks like it's starting to form a rounded bottom in an upturn. You could see this is around 72.40, 72.60, 73 cents. So there is some room for a bounce also in the Australian dollar. Looking now at Europe and the pound, these two could be a little bit in the short term. I think we could see potential for a trading bounce, but I think these currencies could also remain choppy. Why the euro this year faces a lot of political uncertainty. It's unknown if we'll have an election in Italy. We are having elections in France, in Germany, in Netherlands. Greece is on tenterhooks at the moment with the EU and the government at odds once again. It's a possibility their government could fall and an election could be called there too. So there's a lot of potential things that could happen. And also we're seeing the populist movements coming back and a rejection of the elites, a rejection of the EU, that and people that are not benefiting from this are starting to rise up and say enough. So there's a lot more political uncertainty in Europe. So while we're seeing quite a bit of upside for things like gold and yen that were particularly depressed, the euro and the pound could be a little bit more moderate in terms of their recoveries. And the pound, of course, will be 2017 is ongoing uncertainty surrounding Brexit with the Article 50 scheduled to be triggered in March of 2017. For now, however, we're seeing we've got a triple bottom here in the euro dollar. It seems to be forming a nice base between 103.60 and 105. First upside resistance on a breakout around 105.70, then around 106.60, both Fibonacci levels, and this here base, 140 base would measure up to 106.40. So this zone in here is a possibility for a pop. Now here we've got a head and shoulders bottom in the RSI, rare but bullish pattern. We've also starting to get a trend of higher lows in the RSI, so downward pressure is easing. So we could get a pop here in the euro dollar as well. So it does have some room for a trading bounce. But recognize that as we move farther into the year, there is higher uncertainty. With the pound here, we're seeing a broad trading range has emerged between about 120 and about 127, 128. It's drifted back below the middle here, which was around 124, which also, interestingly enough, is about where the 50-day moving average is, and has recently been trading in and around 122.30, give or take. So we'll be watching here to see the RSI seems to be wanting to level off. We'll see. So far, downward momentum has been accelerating. However, if this does pause and hold above 30, it would be a sign of an emerging uptrend. So we do want to keep an eye on that as well. We do get higher lows in the RSI. So the pound has some room for some choppiness. Right now, it's come off. It seems to be flattening out at a relatively higher level than where it was back in October. But we'll see what happens with the pound, given its continued headwinds from Brexit. So overall here, it looks as though the big U.S. rally that unfolded in two big stages, one in November, one in December, is looking pretty exhausted. It's looking like we could see a correction in the U.S. dollar in the first part of 2017, and some currencies may benefit from this more than others. But in particular, so far, it does look like we're starting to see good rebounds starting to be underway in gold and in the yen, and basis forming in other currencies, including the euro and the Canadian dollar.